have been lied to. Every morning, the media, your peers, even the financial gurus online whisper the same seductive lie. Wealth is loud. Wealth is flashy. Wealth is a public performance. They show you shiny cars, sprawling estates, private jets, and you think that's the path. You believe that financial success demands a stage, applause, and the constant validation of others. But that is the trap. That is exactly why most people never escape. There is a hidden architecture, a silent framework that the truly wealthy operate within. It's invisible to most eyes because it doesn't broadcast itself on Instagram. It doesn't beg for likes, retweets, or admiration. It moves quietly, deliberately, and in ways that are invisible to the human ego. And the moment you understand this system, everything changes. Think of it like gravity. We see its effects, yet the force itself is invisible. We don't question why an apple falls from a tree. We just accept the outcome. Wealth operates the same way. There is a force quietly shaping the trajectory of fortunes, silently compounding advantages for some while quietly draining others. Your paycheck, your savings account, your investments, they are all subject to forces most people never notice, forces that can either accelerate you into abundance or trap you in invisible scarcity. And until you recognize them, nothing you do, no hustle, no side gig, no financial tip, will shift the trajectory. Here's the unsettling truth. The world of finance is not chaotic. It is structured. It is governed by principles that are predictable, measurable, and strategic. Yet, the majority of people are playing in a fog. They act emotionally. They spend impulsively. They chase status symbols, and they fail to see the patterns that determine who wins and who loses. The wealthy do not. They operate in silence, guided by invisible levers of compounding advantage, disciplined rituals, and a psychological architecture built for long-term dominance. And silence, this deliberate quiet, is not weakness. It is not hesitation. It is power. The moment you grasp why the richest people in the world never feel the need to announce their wealth, to post their lifestyles, or to seek validation, you will understand the psychological firewall that protects their fortune. This firewall is built on patience, discretion, and a mastery over the impulses that destroy ordinary fortunes. You might already feel the anxiety, the subtle, gnawing awareness that your financial life could be better, smarter, faster. You might have tried the hacks and shortcuts that everyone raves about, only to find yourself a year later in almost the same position, maybe slightly better, maybe slightly worse. That is the silent system at work, ignoring your effort but magnifying the choices of those who understand its rules. Consider this. For every flashy billionaire you see, there are hundreds quietly compounding, quietly building, quietly structuring wealth in ways the public will never witness. Some of them will never be on a Forbes cover. Some will never be interviewed. Some will never need a single hashtag to prove that their life is rich. Yet, when the results are measured, decade after decade, the silent players dominate the financial landscape. They are not lucky. They are not anomalous. They have discovered the hidden geometry of money, and they live by it in ways you have never imagined. By the time you finish this session, you will see the rules of this system. You will see why emotional spending, social comparison, and impulse decision-making are not just obstacles. They are designed by evolution, society, and modern consumerism to keep you in the middle. You will recognize the invisible patterns that dictate financial outcomes and why mastery over them begins not with income, but with mindset, habits, and principles executed in silence. And here's the first open loop. Not all silence is wealth. Some silence is paralysis. Some is ignorance. The wealthy know which silence to cultivate, which to break, and which to wield like leverage in an unseen battle where most people are already losing. That distinction, the strategic, your invisible deployment of quiet power, is the first secret you must understand. In the next moments, you will enter the inner architecture of wealth, the psychology, the behavior, and the systems that allow fortunes to compound quietly. You will confront the invisible forces controlling your financial life and learn why your visible efforts are almost irrelevant if they are not aligned with these silent principles. This is not about flashy advice. This is not about superficial motivation. This is about a structural awakening, a comprehension of wealth as a system, as physics, as biology, as strategy. This is where the structure reveals itself. And the first principle, the principle that changes everything, will not be obvious. It will challenge your assumptions. It will destabilize your familiar beliefs about money, effort, and success. But it will open the door to seeing wealth as the silent, strategic force it truly is. The question is, are you ready to see what most will never see? Are you ready to step into the architecture that governs invisible advantage to align with the principles that the silent wealthy use every day? Because once you do, nothing about your financial reality will ever look the same again. The first invisible architecture of wealth is not a spreadsheet, an investment account, or a business plan. It is a mindset, a structural lens through which money, time, and risk are perceived. Most people think about money as a tool for consumption, for visibility, for immediate gratification. They measure success by social comparison, the neighbor's car, the colleague's vacation, the influencer's lifestyle. This is the trap. That the structure of wealth does not obey popularity, vanity, or appearances. It obeys principles, unseen, precise, and relentless. To understand this architecture, you must first remove the personal shame that has been conditioned into you. If you have struggled financially, if your savings are minimal, if you have felt stuck despite effort, it is not because of weakness or failure. It is because you have been operating in a system designed to favor those who understand leverage, compounding, and discretion. Your emotions, conditioned spending patterns, and social programming are not personal flaws. They are structural obstacles, invisible currents in the financial ecosystem. The wealthy recognize these currents. They see the pressure points that erode ordinary fortunes, small fees, tiny spending leaks, when impulsive purchases that appear insignificant but cumulatively destroy millions over time. These are invisible mechanics, like friction in an engine. Most people never measure them, never calculate them, never account for their cumulative impact. The wealthy do. They identify these drains and build their systems to neutralize them. Here is the first cognitive shift. Wealth is a system, not a result of effort alone. Effort is necessary but insufficient. You can work 80 hours a week, start side hustles, attend seminars, and still fail if you are not aligned with the invisible architecture. Effort without structural insight is like paddling upstream in a river you cannot see. To escape, you must first map the currents. You must understand the channels through which advantage flows and the obstacles that quietly dissipate value. Imagine your finances as a complex organism. Every income source is a vital organ, every expense a metabolic process, and every investment a nerve pathway transmitting potential energy across the system. If one organ is overtaxed or one pathway clogged, the organism falters. The wealthy treat their financial lives like this: a living, self-reinforcing system designed for sustainability and exponential growth. Most people treat money like a consumable. They take, spend, and repeat without attention to systemic balance. The hidden architecture reveals itself in three core patterns: allocation, timing, and discretion. Allocation is not just about percentages. It is about strategically distributing attention, capital, and energy across multiple nodes of advantage. Timing is not just luck. It is about understanding the cycles of markets, our human behavior, and opportunity windows. Discretion is not secrecy for show. It is selective visibility, knowing when to act, when to reveal, and when to remain entirely silent. Master these, and you begin to operate inside the silent system that generates real wealth. This is where most people fail. They try to emulate the visible signs of wealth: luxury, status, recognition, without ever seeing the invisible levers that create it. They copy, they chase, they imitate. And yet, without structural alignment, these efforts are superficial, ephemeral, and often counterproductive. Meanwhile, those who understand the system continue to compound advantage quietly, moving through decades of opportunity with nearly invisible acceleration. Now, consider a subtle but powerful pattern: the psychology of detachment. The wealthy rarely attach identity to their net worth, their possessions, or their status. They separate self-esteem from bank statements. This is not arrogance, it is clarity. Without this detachment, every financial decision is clouded by emotion, comparison, and fear. Emotional decisions erode capital faster than any market downturn ever could. This is the hidden mechanic most people never account for: the emotional tax on financial decision-making. And here is the first open loop for this section. Detachment is not merely emotional, it is structural. It influences which opportunities you see, which risks you can take, and how your capital interacts with the compounding forces around you. Without it, you cannot access the hidden corridors of wealth. Without it, the system operates on you rather than through you. Next, we must dissect the role of incremental advantage. Wealth is rarely created in a single leap. It is engineered through small, precise, compounding mechanisms, minute behaviors, subtle choices, and strategically invisible routines. Consider this: a daily habit that costs $5 but leaks into your lifestyle for decades can erode thousands of dollars. Conversely, a daily habit that earns or saves $5 silently compounds into tens of thousands over the same period. The principle is simple, yet almost no one executes it consistently. This is why the wealthy obsess over micro-behaviors. Every financial interaction is a potential node for compounding advantage. Micro-investments in knowledge, relationships, and timing often yield far greater returns than high-profile financial moves. A single insight into tax optimization, a discrete early-stage investment, or a relationship cultivated in silence can outweigh a decade of conventional effort. But these levers are invisible to the public eye. They do not generate social validation. They generate structural dominance. Understanding the value of hidden leverage is critical. This is the subtle architecture that separates the loud rich from the quietly wealthy. Now, consider the concept of opportunity cost, the silent predator of wealth. Every choice you make has an invisible alternative: the money not saved, the investments not made, the relationships not nurtured. Most people evaluate decisions in isolation, missing the unseen network of consequences. The wealthy think systemically. They consider not just the immediate effect, but the downstream potential across months, years, and decades. This long-range vision allows them to execute actions that appear modest in the present, but become massive in influence over time. And here is a tension point to notice. Most people fear silence. They equate action with visibility, motion with success. They believe that making noise, posting, showing, proving, is proof of progress. But noise in a system designed for compounding is distraction. It dissipates focus, triggers social comparison, and generates emotional volatility. The wealthy, by contrast, cultivate silence as a strategic tool. They create, they build, they invest, all while the world interprets inactivity or invisibility as absence. But the system is working, silently and powerfully, behind the curtain. Here is the structural revelation. Your visible financial life is often a poor indicator of underlying advantage. The social metrics you chase, likes, shares, approvals, do not map to compounding power. The wealthy ignore these signals precisely because they are noise. They operate with a mental model that treats capital, opportunity, and relationships as invisible ecosystems, all designed to converge over decades rather than months. The first principle is now tangible. To align with the architecture of wealth, you must operate in silence, with structural awareness. You must remove emotional impulses, social comparison, and performance-driven validation from the decision-making process. You must map the currents, identify the friction points, and execute with a long-term lens. And here is your first open cliffhanger for the next section. Most people think their behaviors are free. They believe that income alone drives wealth. But behavior, not income, is the invisible determinant. And the traps embedded in human psychology, the behavioral finance pitfalls, emotional spending triggers, and identity-based self-sabotage are waiting to intercept every move you make. Understanding them is not optional. It is mandatory for anyone serious about stepping into the silent system of wealth. If Section 1 revealed the architecture, Section 2 exposes the traps. Human psychology is the silent saboteur of wealth. We are wired to consume, to seek status, and to act emotionally. The very neural circuits that once ensured survival in a world of scarcity now quietly drain our financial potential. Every impulse purchase, every emotional splurge, every keeping up with the Joneses moment is a structural leak engineered by evolution, amplified by society, and weaponized by modern consumerism. The first trap is what behavioral economists call temporal bias, the tendency to favor immediate rewards over delayed outcomes. You see it every day. A flashy gadget, a weekend trip, a spontaneous subscription upgrade. The instant gratification feels justified, rationalized even. But each indulgence silently erodes future wealth. The wealthy exploit the opposite. They defer gratification strategically. They design systems where small sacrifices today accumulate into massive advantage tomorrow. This is not denial. It is structural leverage. And this is why most people never experience real financial freedom. They are trapped in a cycle of immediate emotion, overriding long-term logic. Then comes status illusion, the invisible, almost reflexive need to signal success. Humans are social creatures, and our survival instincts make us measure worth by comparison. In the modern context, this translates to luxury brands, social media bragging, and lifestyle inflation. What the system does not tell you is that every dollar spent on signaling is a dollar diverted from leverage, compounding, or strategic acquisition. Meanwhile, those who cultivate silence avoid the illusion entirely. They understand that status, like noise, is external. Real influence, real advantage, is structural and often invisible. Identity-based financial self-sabotage is subtler, but far more pervasive. Most people make financial choices based on who they think they are, or who they believe society expects them to be, rather than who they want to become. They are playing a role, performing a narrative, and the cost is hidden in small increments. The extra dinner out, the unnecessary gadget, the networking event that produces no measurable ROI. The wealthy, by contrast, redefine their identity around principles, systems, and outcomes. They act in alignment with an internal model of themselves as accumulators, creators, and strategic decision-makers. This is why behavior trumps income every time. Consider the emotional spending trigger. It is everywhere. Stress, excitement, boredom. A single mood swing can result in hundreds of dollars spent impulsively. These are invisible financial predators that compound over years into thousands of dollars lost. The wealthy design buffers, rituals, and systems to neutralize these triggers. They understand that emotion is not eliminated, but harnessed. They treat money as a tool, not a reward. So your emotional impulses are predictable. Predictability is leverage if you recognize it. Ignore it, and it becomes erosion. The psychological architecture of wealth also involves understanding social contagion. Most financial behaviors are learned, mimicked, and reinforced within social networks. Friends, family, colleagues, even the media instill spending patterns, risk tolerance, and consumption behaviors. You may feel autonomous, but your environment is programming you silently. The wealthy intentionally select networks, mentors, and communities that reinforce structural advantage, not impulse. They engineer the flow of influence, while most people are passive recipients. This is why environment is far more than backdrop. It is a lever. And here is your first cliffhanger in this section. These behavioral traps are not merely personal, they are systemic. Every bad habit you have is amplified by invisible economic forces designed to capture attention and divert capital. They are small, almost imperceptible, yet devastating over decades. Understanding them is the gateway to reclaiming control. Now, let's quantify the cost of these traps. Imagine two individuals. Both earn $100,000 per year. One allows temporal bias, status signaling, and emotional spending to dominate choices. The other neutralizes these behavioral leaks. Over 20 years, assuming modest 7% annual investment growth, the first individual might accumulate approximately $550,000. The second, leveraging delayed gratification, discretion, and silent compounding, could accumulate nearly $1.2 million, more than double, without increasing income. This is the hidden calculus most people never see. It is invisible, systemic, and unforgiving. Status illusions also carry an opportunity cost. Every dollar spent on external validation is a dollar diverted from compounding assets or strategic leverage. These diversions are quiet, often unnoticed, and cumulative. They are not catastrophic in isolation, but catastrophic in aggregate. The wealthy treat every decision as an algebraic equation, present cost versus future compounding. Social pressure is acknowledged, but treated as irrelevant to the system. Behavioral finance traps extend to risk misperception. Most people overestimate financial dangers while underestimating behavioral dangers. They fear market volatility, crypto swings, or interest rate changes, yet ignore their own patterns of impulsive consumption, peer pressure, and status-driven decision-making. The wealthy invert this. They embrace calculated financial risk and neutralize behavioral risk. The quiet control over the mind becomes a force multiplier. Here's a system-level insight. Identity is the hidden algorithm governing behavior. If you perceive yourself as someone who saves, invests, and thinks long-term, you unconsciously filter choices, behaviors, and networks to align with that identity. If your identity is someone who enjoys the present, keeps up socially, and spends when convenient, the system, your brain, your impulses, your environment, will continuously sabotage wealth creation. Identity is the invisible anchor. Without it, no system survives. Now, consider the pattern of self-sabotage loops. Now, most people oscillate between ambition and impulse, strategy and emotion, saving and spending. These loops are subtle, repeating silently, and they compound like interest, but in reverse. A $100 impulsive purchase repeated weekly, combined with unnoticed small behavioral leaks, can erode tens of thousands of dollars over a decade. The wealthy break these loops by designing rigid, invisible structures, automated saving, strategic buffers, deliberate social selection, and mental frameworks that preempt behavioral drains. And the open loop for the next section. Behavior shapes capital more than income. Emotion shapes trajectory more than circumstance. Identity shapes results more than opportunity. The next section will reveal how the wealthy translate these psychological frameworks into mathematical compounding, capital thresholds, and wealth velocity, showing why silent discipline creates exponential advantage over time. Behavior without measurement is merely hope. The wealthy understand this instinctively. They translate silent discipline into mathematics. They know that compounding is not just a concept, it is a structural lever that amplifies every small advantage. The average person underestimates compounding because they view money linearly. Earn $100, spend $80, save $20. Repeat. The wealthy view money exponentially. They calculate how $20 saved today, strategically invested, can grow silently into tens of thousands over decades, untouched by noise, emotion, or social pressure. Consider capital thresholds. Most people focus on income, thinking higher pay automatically translates to wealth. This is a critical illusion. Income is the fuel. Capital is the engine. A $50,000 salary managed with precision, allocated with compounding intent, can outperform a $100,000 salary wasted on impulse and status. Capital thresholds are invisible milestones where your assets begin to accelerate autonomously. Before reaching these thresholds, effort alone drives growth. After, systems and leverage dominate. The wealthy prioritize reaching thresholds over flaunting income. They know it is not what you earn, but what you enable your capital to do that defines trajectory. Compounding operates in three dimensions: time, rate, and control. Time is obvious. Decades matter far more than months. Rate refers not just to return percentages, but to the strategic positioning of assets, skill leverage, and behavioral discipline. Control is the often overlooked dimension, the degree to which you prevent emotional leaks, timing mistakes, and unnecessary friction from sabotaging growth. The wealthy manipulate all three simultaneously. They accelerate growth silently, not through luck, but by mastering every variable in the compounding equation. Now, let's examine wealth velocity, the rate at which capital transforms into additional advantage. Two individuals may have identical net worth at age 30, but one reinvests efficiently, optimizes risk, and leverages opportunities, while the other remains stagnant. By 40, the first has generated multiple streams of compounding growth. The second barely keeps pace. Velocity is silent, invisible, and measurable only when time has passed. The wealthy treat it like a precision instrument. They design actions not for immediate gratification, but for speed of capital movement, multiplying advantage in ways outsiders rarely perceive. Here is a micro cliffhanger. Most people miscalculate their financial trajectory because they fail to account for small, invisible frictions. Transaction fees, minor lifestyle inflation, behavioral leaks, and suboptimal timing quietly suppress compounding power. Over decades, these seemingly trivial factors can result in a 40 to 60% loss of potential growth. The wealthy eliminate friction relentlessly. They automate, they delegate, they time perfectly, and they maintain strategic detachment, allowing compounding to do its work unhindered. Numbers are not abstract. They tell a story. Let's model a simple compounding framework. Person A saves $500 per month at a 6% annual return for 20 years. Total contributions, $120,000. Total balance, approximately $218,000. Person B saves $500 per month at the same 6% return, but increases contributions by 5% annually, reflecting silent, strategic behavioral escalation. Total contributions, approximately $163,000. Total balance, approximately $326,000. The same principle applies to time leveraging, skill stacking, and opportunity alignment. Minor adjustments in contribution, timing, and strategy produce exponential differences over decades. This is why the wealthy obsess over frameworks invisible to the public eye. Small, consistent changes, executed silently, accumulate into enormous asymmetry. Now consider escalation examples. Early capital can generate outsized advantage due to compounding thresholds. A $50,000 initial investment, deployed with patience, grows more than the sum of incremental contributions made without an initial base. Early advantage begets further advantage, creating feedback loops that are invisible yet relentless. The wealthy understand these loops instinctively. They structure early wins and leverage them for long-term dominance. Mathematics also clarifies risk management. The wealthy calculate risk not just in probability, but in capital exposure relative to velocity. They deploy assets strategically, ensuring that no single event disrupts the system's long-term compounding. Most people treat risk superficially, diversify minimally, avoid loss entirely, or chase volatile gains. This approach creates stagnation. The wealthy embrace calculated, structural risk precisely to accelerate the compounding engine. Here is an open loop. Compounding is invisible, velocity is silent, and thresholds are unseen until crossed. Most people never recognize them in time. Yet, when these principles align, emotion, behavior, and mathematics, wealth becomes not just an accumulation of dollars, but a self-reinforcing system that grows autonomously, silently, and relentlessly. And here is your first tension trigger for the next part. The numbers reveal the uncomfortable truth. Time is wealth's ally only when aligned with disciplined behavior. Misalignment ensures effort is wasted and capital stagnates. The wealthy do not rely on luck. They rely on structural inevitability, systems designed to convert patience and discretion into exponential growth. Section 3. Part 3. Let's introduce numerical modeling of escalation. Imagine two individuals. Individual X invests $10,000 annually at a 7% return, starting at age 25 until 65. Total contribution, $400,000. Final balance, approximately $1.1 million. Individual Y starts at 35. Same annual contribution, same return. Total contribution, $300,000. Final balance, approximately $630,000. The 10-year delay cost individual Y nearly half of what could have been silently accumulated. This is the invisible, structural penalty of misaligned behavior and delayed action, a mathematical consequence of ignoring the architecture outlined in sections 1 and 2. Next, let's quantify velocity through skill leverage. The wealthy often earn similar incomes to peers, but use skill stacking, combining knowledge, influence, and access to increase the velocity of capital deployment. A single deal, insight, or network connection can multiply returns silently without increasing visible effort. This is why wealth is not always proportional to income. It is proportional to the strategic application of resources amplified by compounding frameworks. And finally, consider the invisible multiplier of time. Every decision, when made with structural discipline, creates invisible leverage. Small savings, minor behavioral adjustments, and incremental learning compound over decades into significant advantage. This multiplier effect is why the silent wealthy rarely appear to work harder than anyone else. They leverage structural inevitability over superficial effort. Here is the section's final micro cliffhanger. Intelligence alone does not produce wealth. Knowledge alone is insufficient. Effort without system alignment, your behavior without structural discipline, and time without compounding awareness are meaningless. The wealthy integrate psychology, mathematics, and patience into a silent engine of advantage. The next section will reveal why highly intelligent, well-informed individuals still fail, despite their ability to calculate, plan, and strategize. Intelligence is not immunity. Brilliance does not equal financial success. Every year, countless highly educated, analytical, and strategic individuals, people who can calculate risk, model markets, and read balance sheets, fail to build meaningful wealth. Why? Because intelligence without system alignment is wasted potential. It is the silent trap that lures the capable into patterns of overconfidence, lifestyle inflation, and decision fatigue. The first factor is social programming. From childhood, a society implants scripts about consumption, status, and what it means to succeed. Degrees, titles, and salaries become symbols of identity rather than tools for structural advantage. These scripts create invisible expectations: the new car at 25, the luxury apartment by 30, the image of having arrived. The wealthy recognize these pressures but choose selectively which scripts to follow and which to ignore. For the average intelligent person, ignoring them is countercultural and psychologically uncomfortable, leading to decisions that erode capital silently. Next is lifestyle inflation psychology. As income rises, expenses rise faster. People subconsciously upgrade homes, cars, dining habits, and travel experiences, often justifying these purchases as deserved rewards. Yet the invisible architecture here is brutal. Every dollar allocated to lifestyle consumption is a dollar removed from compounding, leverage, and strategic growth. The wealthy consciously resist this temptation. They create boundaries, frameworks, and silent rituals that ensure income growth feeds structural advantage, not superficial visibility. Environmental pressure compounds this trap. Humans are adaptive. Our behaviors conform to surroundings, peers, and networks. Friends, family, and colleagues influence spending, risk tolerance, and ambition. An environment dominated by consumption norms acts as an invisible drain, constantly triggering emotional spending and opportunity misalignment. Wealthy individuals engineer their environments intentionally, select networks, curated mentors, and communities that reinforce structural behaviors. Ordinary intelligent people remain passive in their environment, unaware that social pressure erodes compounding potential daily. Decision fatigue is another invisible killer. High-functioning individuals make hundreds of financial decisions weekly. Small purchases, investment choices, budget allocations, lifestyle adjustments. Every decision exacts a cognitive toll. As fatigue accumulates, the brain defaults to short-term gratification, emotional choices, and suboptimal risk management. The wealthy anticipate this. They design decision architecture, automation, delegation, and preset systems that remove emotional and cognitive friction, preserving clarity for high-leverage decisions. Ordinary intelligence, left unstructured, is overpowered by fatigue long before long-term growth is achieved. Now, let's dissect the paradox of knowledge. Many intelligent individuals immerse themselves in financial information, market news, strategy books, podcasts, yet fail to translate knowledge into measurable advantage. Why? Because information alone does not overcome behavior, identity, or compounding principles. Knowing is not doing. Intelligence without execution, without alignment to system rules, is inert. The wealthy, however, convert knowledge into structured action, deliberate investments, repeated frameworks, and consistent compounding behavior. Consider the illusion of control. Highly capable individuals often overestimate their ability to predict markets, manage risk, or time opportunity. This illusion leads to emotional overreaction, impulsive repositioning of capital, and unnecessary volatility. Meanwhile, those who embrace systemic inevitability, using compounding, thresholds, and structural discipline, experience consistent, silent growth. Intelligence alone cannot replicate the invisible architecture. Without alignment to structural principles, it becomes noise, not advantage. Lifestyle inflation interacts with this intelligence paradox in subtle ways. Smart earners feel justified in maintaining or escalating consumption proportional to income. They rationalize luxuries as earned rewards. The hidden system, however, rewards restraint, discretion, and reinvestment. Wealth accumulation is a game of delayed gratification amplified through structure. Those unable to delay gratification, regardless of IQ, knowledge, or skill, remain trapped in the middle. Now consider environmental triggers at a behavioral level. Every social interaction, or every cultural expectation, and every peer comparison subtly manipulates spending and investment patterns. These forces are invisible yet persistent. The wealthy do not resist passively. They engineer influence, selectively exposing themselves to mentors, networks, and habits that reinforce advantage. Ordinary individuals are overwhelmed by these pressures, unconsciously prioritizing social alignment over capital velocity. Finally, let's explore decision fatigue economics quantitatively. Suppose a high-performing professional makes 100 financial decisions per week. If 10% of these are emotionally compromised due to fatigue, misalignment, or social pressure, and the average misstep costs $50, that's $500 weekly, $26,000 annually, silently eroded. Over a decade, this equals $260,000 before considering lost compounding potential. Why the invisible drain is massive, systematic, and rarely noticed until decades later. The wealthy neutralize this drain with predefined decision frameworks, automatic investment allocations, passive saving structures, and pre-committed behavioral rules. Here is the systemic insight. Intelligence amplifies outcomes only when combined with structural discipline, environment management, and behavioral control. Without these, brilliance becomes a fragile advantage, easily derailed by invisible friction. The quiet wealthy do not rely on intelligence alone. They rely on aligned execution. This is why highly capable individuals often plateau despite knowledge, skill, and potential. And here is the cliffhanger for the next section. Understanding why intelligence fails leads directly into the strategic wealth blueprint. But the next module will show how the wealthy transform knowledge, behavior, and time into structured, repeatable systems that generate compounding advantage, asset acquisition logic, and asymmetrical growth. It is here that silent principles crystallize into tangible action. The strategic wealth blueprint is not a generic plan. It is an invisible engine. It transforms capital, behavior, and time into compounding advantage that works quietly, relentlessly, and predictably. Most people think wealth is linear: earn, spend, invest. But the wealthy understand it is multidimensional, systemic, and layered. They think in terms of assets, risk structures, skill leverage, and cash flow architecture, all operating simultaneously. This blueprint is the map they follow, silently, while the majority chase noise. Step 1. Capital structuring. His wealth is organized, not accumulated haphazardly. Income is treated as fuel, not status. A portion goes to liquid emergency buffers, funds immediately accessible to neutralize behavioral and environmental risk. Another portion is allocated to diversified asset categories: equities, real estate, private ventures, and alternative investments. Each allocation is intentional, designed to balance growth, security, and compounding potential. The wealthy do not hop between investments. They position capital to maximize structural advantage over decades. Step 2. Asset acquisition logic. The wealthy prioritize assets that generate autonomous growth. Real estate producing rental income, businesses that scale without constant involvement, dividend-paying equities, and intellectual property. All these assets serve as silent engines of compounding, as acquisition is not about variety for visibility. It is about efficiency, leverage, and velocity. Every asset must contribute to the system, or it is discarded. Noise and vanity purchases are invisible drains and avoided. Step 3. Risk mitigation architecture. Wealth is fragile to poor structure, emotional decisions, and environmental shocks. The wealthy design redundant safety nets, insurance, legal protections, diversified portfolios, and pre-committed withdrawal rules. Each decision considers downside exposure relative to velocity, compounding potential, and systemic impact. Risk is not eliminated. It is engineered and contained, allowing capital to grow without catastrophic interruptions. Here is the first micro cliffhanger. Most people misunderstand risk. They fear volatility while ignoring behavioral fragility. The wealthy invert this equation, neutralizing human error and structural leaks before leveraging growth opportunities. Step 4. Skill stacking. Wealth is not generated by income alone. The wealthy combine skills strategically: negotiation, financial literacy, operational knowledge, network influence, and psychological control. Each skill amplifies the others, creating leverage points that exponentially increase capital velocity. Skill stacking is deliberate, cumulative, and silent. It is rarely public, yet its effects are profound. Those who ignore this step rely entirely on labor for income, while the silent wealthy multiply results without visible effort. Step 5. Cash flow architecture. Silent wealth is defined by predictable inflows and autonomous reinvestment. Income streams are organized by liquidity, growth potential, and risk alignment. Excess cash is strategically redeployed into compounding engines. Most people allow cash to dissipate into lifestyle or status symbols. The wealthy never confuse spending with investing. Every dollar is evaluated against long-term structural impact before it leaves the system. This is the invisible firewall protecting compounding advantage. Step 6. Long-term asymmetry thinking. The wealthy do not evaluate decisions by short-term outcomes. Every action is measured for asymmetric impact. Which moves generate outsized benefit relative to cost, risk, or effort? Strategic patience, delayed gratification, and opportunity timing are engineered to exploit long-term asymmetry. Ordinary individuals misinterpret short-term underperformance as failure, leading to impulsive decisions that dismantle growth. The wealthy thrive precisely because they design for structural inevitability, not immediate gratification. Here is a tension point. Most financial advice focuses on linear gains. Save 10%. Invest here. Increase income. The blueprint requires thinking in decades, not months, and in systemic feedback loops, not isolated actions. It is here that silent compounding multiplies advantage beyond visible effort. Step 7. Integration of behavioral discipline. Principles from sections 1 and 2, detachment, identity alignment, emotional control, and environmental engineering, are embedded into the blueprint. Asset allocation, risk management, and cash flow design are ineffective if human behavior sabotages execution. The wealthy treat behavior as part of the architecture, not a separate concern. They automate, pre-commit, iterate and reinforce mental models to prevent leaks before they occur. Step 8. Strategic sequencing. The order of execution matters more than effort alone. Emergency buffers precede high-risk ventures. Knowledge acquisition precedes large-scale investment. Skill stacking precedes entrepreneurial risk. Each sequence is deliberate, optimizing compounding, velocity, and leverage while minimizing friction. Most people execute in random order, unaware of invisible penalties that slow growth exponentially. Step 9. Network leverage. Relationships are curated for strategic influence, not social validation. Access, insight, and opportunity flow through silent networks. The wealthy operate in communities that reinforce structural behavior, provide mentorship, and open doors invisible to outsiders. Ordinary intelligence alone cannot access these corridors. Structural positioning and behavioral alignment are prerequisites. And here is the cliffhanger for the next section. The blueprint is now complete, but it remains static without acceleration. Silent discipline generates growth, but true wealth multiplies when dual engines of income and asset leverage are activated strategically. The next section will reveal the acceleration phase, where timing, optionality, and leverage converge to explode compounding potential. Building wealth quietly is one thing. Accelerating it exponentially is another. The wealthy understand that static systems, no matter how disciplined, eventually plateau without activation of dual engines, income and assets working in tandem. Most people focus on one engine. Either they chase higher income, or they hope investments will magically compound. This is the trap. Real acceleration occurs when both engines are aligned, synchronized, and strategically leveraged. The first engine, income, is treated as fuel rather than proof of success. The wealthy optimize for stability, scalability, and skill leverage. Every dollar earned is mapped into the compounding system outlined in Section 5. Importantly, income is never spent impulsively. It is converted into velocity, capital deployed strategically, creating a feedback loop that multiplies itself silently. Ordinary earners confuse income with wealth. The wealthy know it is merely the entry point. The second engine, assets, is the multiplier. assets generate autonomous growth, cash flow, and optionality. Real estate, private ventures, equities, and intellectual property are deployed not just for income, but for leverage and asymmetrical advantage. Each asset interacts with the system, producing compounding effects beyond visible effort. Timing, allocation, and behavioral discipline ensure that assets accelerate silently, often unnoticed by peers. Here is a critical open loop. Acceleration is not simply earn more and invest more. It is a systemic synchronization where income fuels assets, assets create optionality, and optionality expands influence and capital velocity. Without coordination, both engines operate inefficiently, producing modest growth while leaving compounding potential untapped. Next, we introduce optionality strategy, the invisible lever that multiplies advantage beyond linear effort. Optionality is the capacity to act decisively when opportunity arises, while maintaining minimal downside. The wealthy cultivate optionality by maintaining liquidity, network access, diverse skills, and situational awareness. Each decision is evaluated not only for immediate outcome, but for the doors it opens in the future. Ordinary individuals react. The silent wealthy position themselves to strike when systemic conditions favor maximal leverage. Leverage is the next pivotal concept, but it is not uniform. Strategic leverage magnifies growth with controlled risk. Debt, partnerships, operational scale, and intellectual property are deployed with precision. Abuse leverage, and the system collapses. Control leverage, and the compounding engine multiplies silently. Now, the difference between ordinary investors and the quietly wealthy is mastery of invisible ratios: exposure versus velocity, risk versus asymmetry, timing versus emotion. Timing is the final multiplier in the acceleration phase. Markets, opportunities, and behavioral patterns operate in cycles. The wealthy recognize structural windows where capital, skills, and influence converge. Acting too early or too late dissipates advantage. Acting precisely produces outsized, almost invisible gains. This is why they rarely appear in a hurry. Their actions are silent, deliberate, and calibrated for maximum systemic effect. A micro cliffhanger here: most people fail to accelerate because they treat opportunities as discrete events rather than systemic multipliers. Income alone, assets alone, or knowledge alone cannot generate exponential growth. Only the synchronized application of engines, optionality, leverage, and timing produces acceleration beyond what effort or intelligence alone can achieve. Now, let's quantify dual-engine acceleration. Imagine two individuals. Individual A earns $150,000 annually, invests in low-velocity assets, and spends a significant portion on lifestyle. After 20 years, capital grows modestly to approximately $800,000. Individual B earns the same, but systematically allocates 50% of income to high-velocity assets, maintains optionality in liquidity and skill, leverages strategic partnerships, and times deployment of capital. After 20 years, total net worth exceeds $2.1 million. The silent multiplier, behavior, timing, leverage, and optionality produces growth nearly 3 times higher without additional income. The wealthy also exploit hidden asymmetry in acceleration. Small advantages, compounded through dual engines, produce disproportionately large results. An early strategic investment, combined with skill stacking and network access, can create wealth multiple times larger than income alone would allow. This is the silent architecture outsiders rarely observe. Finally, acceleration requires emotional discipline under stress. When opportunities arise, the nervous system triggers fight or flight responses. The wealthy have trained behaviorally and psychologically to act decisively without ego or emotion interfering. This combination of internal control and structural leverage produces a silent velocity few ever witness. The open loop for the next section. Acceleration is meaningless without identity alignment. Systems, capital, and leverage can produce wealth, but only if the individual's psychology, delayed gratification, and long-term vision are calibrated. Section 7 will reveal the identity evolution that allows these engines to operate at full power for decades. Without it, acceleration is wasted, misdirected, or prematurely stalled. Wealth is not merely an accumulation of assets or income streams. It is a reflection of identity. Without the internal alignment of self, all external systems eventually falter. The wealthy know this instinctively. Money, opportunities, and leverage amplify who you already are. If your identity is fragmented, impulsive, or externally validated, the system magnifies weaknesses as much as it multiplies advantage. This is why identity evolution is the final, invisible engine of silent wealth. The first pillar is internal psychological shift. Most people define themselves by external markers: salary, titles, possessions. These markers are volatile, reactive, and socially contingent. The wealthy anchor identity internally: competence, discipline, strategic patience, and mastery over impulses. They detach self-worth from external validation. This detachment is not absence of emotion, it is clarity, a recognition that their actions, not social signals, determine structural advantage. Without this shift, compounding systems operate at partial capacity, leaking potential silently into emotion-driven decisions. Closely tied to identity is delayed gratification rewiring. Behavioral science shows humans are wired to overvalue immediate rewards, often sabotaging long-term outcomes. The wealthy intentionally rewire this neural bias. What habits, mental models, and environmental design are synchronized to favor long-term outcomes over immediate pleasure. Savings, investments, skill stacking, and network cultivation become automatic, effortless, and emotionally neutral. Over decades, this rewiring produces structural advantages invisible to the untrained eye. Strategic detachment is another pillar. The wealthy learn to act without ego contamination. Opportunities are evaluated dispassionately. Is this move structurally advantageous? Does it accelerate velocity, optionality, or compounding? Emotional attachment to status, fear of missing out, or pride-driven decisions are treated as friction points and neutralized. This detachment allows wealth to accumulate silently, uncorrupted by human fallibility. Next is the principle of thinking in decades, not months, where ordinary individuals evaluate performance on quarterly metrics, paychecks, or social comparison. The wealthy extend vision across decades, designing every decision for long-term asymmetry. Investment cycles, skill acquisition, network leverage, and behavioral discipline are all calibrated with horizon thinking. This perspective allows them to endure short-term volatility and apparent stagnation, knowing structural advantage compounds silently in the background. Identity evolution also includes environmental alignment. The mind cannot operate in isolation. Behavior, thought patterns, and decisions are deeply influenced by surroundings. The wealthy curate environments, friendships, mentors, and routines that reinforce their internal models. Ordinary intelligent individuals often ignore this, leaving their behavior subject to social and cultural friction. Identity evolution is inseparable from environmental engineering. Consider habitual consistency under friction. The wealthy understand that discipline is not merely a conscious choice, it is automated through habits and mental frameworks. Savings, skill acquisition, strategic networking, and investment behavior are routinized to prevent cognitive fatigue from undermining long-term goals. Systems work because the individual has evolved to consistently align identity, emotion, and action. Now examine the invisible multiplier of self-mastery. Dual engines, optionality, leverage, and compounding velocity all depend on identity alignment. Without delayed gratification, internal detachment, and horizon thinking, even the most sophisticated external systems fail. The wealthy continually audit their psychological frameworks, ensuring that their internal state matches the structural system in place. This evolution transforms behavior from reactive to proactive structural alignment. Emotional impulses no longer hijack decision-making. Social pressures are neutralized. Risk is evaluated objectively. Opportunity is recognized with clarity. Time, patience, and discipline are not burdens. They are internalized strategies that operate silently, producing structural advantage without the need for external validation. Finally, here is the cliffhanger. Identity evolution is the bridge between acceleration and sustainability. Without it, leverage collapses, assets underperform, and compounding is diluted. The next section, Wealth Redefinition, will expand the lens, showing how the wealthy reinterpret money, freedom, and power beyond conventional metrics, ensuring that every principle applied serves a life of autonomous, silent, enduring advantage. Most people define wealth by numbers in a bank account, the car they drive, or the prestige attached to their title. This is an illusion, a social mirage. The quietly wealthy understand that these metrics are superficial, transient, and externally validated. True wealth is structural autonomy, the ability to act without external compulsion, to allocate time, energy, and capital in alignment with long-term advantage. Redefining wealth is the silent step that differentiates accumulation from life mastery. The first principle is wealth beyond income. Income is simply a flow. Assets are leverage. Real structural wealth is the accumulation of capital that produces compounding advantage independently of labor. The wealthy think in systems, not salary. Every decision is evaluated for whether it increases independent compounding capacity. They don't chase numbers. They chase mechanisms that generate capital velocity. Ordinary observers confuse high income for high wealth, missing the invisible architecture of autonomous growth. Next is freedom beyond consumption. The wealthy realize that consumption is a poor proxy for liberty. Luxury does not equate to autonomy. Freedom is the ability to make decisions without constraint, to act in alignment with strategy rather than emotion, social expectation, or external pressure. By creating structures where assets, skills, and networks generate autonomous leverage, they operate in a domain few can access, a life unbound by reactive circumstance. The third pillar is power beyond status. Status is external, often fleeting, and vulnerable to social volatility. True power is influence over systems, outcomes, and opportunities. The wealthy generate influence silently, through network positioning, skill accumulation, strategic leverage, and disciplined compounding. They move decisions, markets, and relationships in ways that are rarely visible but profoundly consequential. Status may fade, but structural power compounds, often unnoticed, across decades. This redefinition extends to risk perception. While most people fear loss or volatility, the wealthy see risk as an asymmetrical lever. By reframing risk through structural advantage, They are willing to take positions that outsiders avoid, with accelerating compounding silently. Fear becomes a tool rather than an obstacle, a lens through which opportunity is magnified rather than diminished. Now consider time as currency. For most, time is linear and reactive, spent chasing work, social validation, or fleeting pleasures. The wealthy monetize time differently. They design systems to free their most valuable asset, attention, for high-leverage decisions, creation, and opportunity discovery. Wealth, in this sense, is the ability to control the flow of time itself, turning decades into silent compounding advantage. Finally, all these redefinitions converge in structural intentionality. Wealth is no longer a number, a title, or a lifestyle. It is a framework for autonomous advantage. Freedom is not vacations or leisure. It is the ability to direct resources, influence outcomes, and navigate opportunities without distraction. Power is not visibility. It is the capacity to move capital, ideas, and decisions efficiently through networks and systems. Income is not a metric. It is a fuel source feeding the larger self-sustaining engine of strategic advantage. The wealthy live by this redefinition silently. Their actions are deliberate, incremental, and aligned with decades-long compounding principles. Ordinary observers mistake their quiet discipline for inertia, failing to see the invisible network of leverage, identity alignment, and system mastery operating behind the scenes. And here is the final open loop before closure. The system is complete. Psychology aligned, identity evolved, assets structured, acceleration engines active. But now comes the ultimate test: integration into action, challenge, and ascension. The final section will transform these principles into a tangible call to mastery, revealing the path from knowledge to internalized, lived wealth. You have seen the invisible architecture, the psychology, the behavior, the systems, the compounding, and the identity evolution. You understand why intelligence alone fails, why status illusions destroy opportunity, why social pressures erode wealth silently, and how acceleration engines multiply advantage. But knowing is not enough. The question now is, will you integrate it, live it, and defend it? This is your challenge. Every principle outlined, delayed gratification, structural discipline, dual engine acceleration, skill stacking, network leverage, and wealth redefinition, requires consistency, courage, and clarity. Half measures are the enemy. The system does not reward intention alone. It rewards execution aligned with identity and time. Can you withstand short-term discomfort for decades of silent advantage? Can you act when emotion tempts you to drift? Can you protect your environment, engineer your habits, and think in decades while the world demands instant results? Visualize your future self. Not the one defined by social approval, flashy purchases, or transient titles, but the one who has mastered internal alignment, structural advantage, and systemic compounding. Picture the life where income fuels autonomous growth, assets generate velocity, networks amplify optionality, and every decision is filtered through decades-long horizon thinking. This is wealth lived quietly but fully. Freedom beyond consumption, power beyond status, and clarity beyond chaos. Here is the direct call. Adopt the invisible system. Integrate psychology with structure, identity with action, patience with leverage. Do not be distracted by ephemeral trends, social noise, or instant gratification. Every choice, every allocation of attention and capital must serve the silent compounding of your long-term advantage. Begin today, in small, deliberate steps, because momentum compounds faster than effort alone. And remember this unforgettable closing line: wealth is not what you show. It is what quietly grows when no one is watching.